Today I'm going to talk about 6 reasons you need life insurance. If this is your first time at our channel or you haven't subscribed, click on the subscribe button at the bottom. My name is Travis Sickle, certified financial planner with Sickle Hunter Financial Advisors. There are a ton of reasons why you need life insurance. These are only 6 of them. Number 1, ensuring your insurability. What on earth does that mean? Ensuring your insurability is getting life insurance when you're healthy. And usually that's today. So before you get married, before you have kids, before you retire, all of these things before you need them, you need to make sure that you have life insurance. And if something were to happen to you where you didn't qualify for insurance any longer, at least you have it now for those future events. Number 2, do it for the kids. The kids are expensive. The USDA estimates that each child will cost an estimated $233,000 over their life. So if you have one kid, $233,000, 2, $466,000. That's quite a lot of money. I have 3 kids, and that's almost pushing $700,000 in just taking care of your kids up until the age of 17. So this does not include college. Number 3, your kid's college education savings plan. Now, it doesn't matter if you're not saving, you're going to save, or you've already started saving. This is a huge, huge goal. Inflation for schools is at 5 and 6%. It's significantly higher than regular inflation. So let's take a look at some of these costs. So if we're looking at somebody that's born today and is going to the University of North Carolina, it's an excellent school, $41,140. That's a lot of money. And if we inflate that out, we're looking at over $426,000. Look at that first year, 2036. 2036, over $99,000 for that year. The next year, 103, 109, 114. It's showing you the cost continuously rising. So this neat little calculator here, it's taking the cost of actual colleges today, the cost of colleges today, and inflating them out. So if we look up here, we can look up almost any school. Let's put in Harvard in there, right there. Next, showing you at $56,000, gives you the breakdown right there. University of Florida, put it in there. Next, $19,000. So you can do in-state or out-of-state. Out-of-state obviously is going to be more expensive. If we click on that, we're going to get $41,534. In-state, we're looking at $19,257. So if we inflate this one out and I click save, just under $200,000. So the costs can vary widely. But the thing to understand is the rapid inflation of school and saving for it. You want to make sure that gap is protected. So you might be doing everything right, saving for your kid's college education, but that's a massive expense. It's almost just as much, depending on where you go, as it is to raise them. So that immediately doubles the cost. And number 4, spouse living expenses. Now, these expenses could change so drastically. But if you look at the spouse's living expenses, whether or not one person works or it's a dual income household or whatever the structure is, most people get comfortable and adapt to their current income lifestyle. And really, whether or not we think we can adjust to the loss of a spouse, there's a grieving period and adjustment periods. And those could be financially catastrophic. Now, number 5, I left for retirement, specifically apart from living expenses. Because if you have a lot of years until retirement, you have more of a chance of recovery, or a spouse has more of a chance of recovery over that time frame. But let's say that you're nearing retirement 5 or 10 years out. That's a tough recovery because a lot of the high income years come towards retirement, which also means a lot more saving. Number 6, a fire sale. So what's a fire sale? So we call it a fire sale because that asset has to sell quickly. And usually that means at a discount. So not only are we losing the asset, but now we're selling it for much less than what it's worth. Let's say that there is a debt payment, such as a mortgage or another debt on your house or any other asset that you own. If the beneficiary doesn't have cash or they don't have access to cash, they might actually lose the asset that you worked really hard to pass along. So to close this gap, you can look at life insurance specifically to pay off some of those debts, especially when they're linked to an asset that you want to transfer. As you can see, there's a lot of different stages, a lot of different reasons of why you need life insurance. And it could take on different meanings for you and cover different things over time. Bottom line, take a look at your life insurance coverage. Make sure it's enough. If you've enjoyed this video, be sure to subscribe and leave your comments down at the bottom.